Ajay Bagga as well to discuss the precarious market at hand. And Ajay, good afternoon. The selling pressure has kicked in and how? While what seems to be the consensus is that the year ahead will be marked by quite a bit of volatility. You're of the view that we are likely to see a bottom before elections?
Yeah, I think around March, April is when I'm expecting that pessimism will be at its height, and more or less, 2 out of 3 outcomes will be welcome to the market. That if there is a strong, formation at the center, you would get decisive economic action, and that would be welcomed. The only outcome which will not be welcome is if it's a total hodgepodge of a coalition with very weak partners who pull in different directions. So if there is, a single formation, whether UPA or NDA, which gets about 220 odd seats, I think the market would digest that and move on. But going into that, there's just too much of a domestic overhang. In spite of fundamentally we are looking at a better earnings growth next year, markets should have been discounting that and going up rather than going down. So the big factor is the political. Of course, the global issues remain, and we don't expect very big FI inflows in the light of the global issues, from liquidity tightening to slowdown in economies to the trade war which is ongoing and which is now having second order effects into the Taiwans, into the Koreas of the world as well, which are part of the Chinese supply chain.
Right. Ajay, what is the biggest risk to your mind in 2019?
Well, sitting here today, biggest risk is that 1 out of 3 outcome of not a strong central government in India. I think that remains one of the biggest risks, because that will spook foreign investors, that will stop future investments by domestic companies, and will spoil the sentiment a lot. So I think that remains the biggest risk. Globally, there are quite a few, but I would say the liquidity risk is the worst. Fed is on course right now to tighten by about $50 billion a month. So if that continues, then there is going to be a lot of liquidity going out of global markets, and there is no replacement party coming by. ECB also stopped its quantitative easing as of December. So there's not going to be any further easing, even though they've postponed tightening till at least September. And we feel that will not come through this year at all, given the slowdown that's happening. Germany had a weak PMI in the third quarter. We had very poor results from Switzerland, Sweden, Italy. So Europe is not looking very strong anyway. So I don't think the ECB can tighten this year. But the major thing will be if Fed now, in the first quarter sometime, steps up and says, given the slowdown that's happening and the trade war second order effects, we are stopping the balance sheet tightening. I think that will be conducive to markets. Until then, this will be the biggest overhang. There will be geopolitical reasons from time to time, but we have digested a lot over the last 3 to 4 years. I think those will get digested.
Well, as a geopolitical, we would not know what would pan out. Liquidity, we might just hazard a guess that what would happen, but we are not sure when liquidity comes and goes out. But what we can discuss is what's there in front of us, and I want to question you more on what's happening related to banking and NBFC space. And when it comes to RBI relaxing lending norms for MSME, most of the experts who came on our channel today were saying that this is good from borrower's point of view, but lenders may not benefit too much out of it. Market is talking something else. In a market which is going down by 145, 150 points Nifty, Federal Bank is up by 2%. We are seeing some of the other mid-cap banks also doing pretty well. They have given up their gains, but they are doing good because on back of this news. What is your outlook on this mid-cap banking space and this news flow related to MSME?
MSME, Siddharth, in the short term, it helps banks to, postpone the issue of recognition of MSME defaults. Normally, MSME NPAs are at a much higher rate than the large corporate defaults. Caveat to that is, in the last infrastructure cycle, what we saw, coming to fruition by about 2015, when most of the recognitions happened, we realized 22% was the corporate NPA rate, which was a blend of large corporate and MSME put together. But MSMEs are on average a higher default rate than large corporates, even though large corporates are very chunky, and we had a very unfortunate 6-7 years of NPAs. So this move by RBI was seen as positive for stocks, but today it's been, I think, more global issues have overtaken, and we are just doing a follow-up action into the global issues. Otherwise, it gives some breather to NBFCs and to banks as well to postpone the recognition that is capital accretive in a sense, without really putting in more capital. At least you're not putting in capital towards provisioning, just a 5% provision over and above the normal 15 or 25% that was being taken. So that against a standard provision today of about 66%, that's the kind of leeway it will give to banks in not recognizing those non-standard loans, but just restructuring them for the next 1 year. So it is some amount of leeway, liquidity positive. Overall, will it help the sector? I really don't think so, because all the restructurings that happened from 2009, 2010 onwards, ultimately it becomes a huge asset bubble, and it bursts like it did in 2015-16. Where we came to a number of 16 lakh crores sitting as restructured assets, be it NPA recognized or unrecognized. So 12-13 lakh crores of MSME loans, how much of that is bad loans? Very tough to say, but it gives banks some amount of leeway now. So it should have been positive for mid-cap banks and other banks which have MSME exposures, and also to NBFCs.
Among financials, Ajay, where would your bias be?
I think two spots really stand out. One is private sector banks, which are retail focused. They continue to do well, and there is a huge catchment area for them in terms of retail loans, where they will have a good growth. And second is the turnaround stories, which is private sector corporate focused banks. I think those two will stand out. Public sector banks turnaround still some time away. You will have accidents like ILFS happening every once in a while. Even though NPAs have plateaued, there is more injection of capital in them, so we are seeing trading bounces. But from an investment perspective, I think you have these two areas which are much better. Third would be the private insurers and asset management companies. I think there's a long decadal growth ahead of these companies. Those can be looked at, again, not very low or very cheap in terms of valuations, but there's a lot of growth embedded, lot of underserved market potential that is there for the insurers and the asset managers. I think those can be looked at as well.
Ajay, let's also get in a sense as to what the outlook is on some of the crude oil linked companies. The consumption theme, so to speak, has done a fair job of seeing an outperformance in overall volume growth. There are the paint companies, etc. What is the outlook given the acute volatility that we've witnessed in crude oil prices, although now we're seeing some stability on some of the crude linked names? Is there merit?
Yeah, definitely. Paint companies have done very well, and in fact, they were taking price hikes because their normal contracts are across a few weeks, if not months. And as the prices have fallen, that will flow through into the margins. So there was a bidding up of paint companies almost immediately, even though that flow through might probably come in the fourth quarter. So we'll look at the management guidances, but our own oil marketing companies I'm not so gung-ho about. Reasons being, one, there would be some inventory losses because of the sharp fall in the crude. Second, the GRM reported GRM numbers are not looking very good. And third, there have been some amount of refinery shutdowns, which are normal maintenance linked shutdowns in the last quarter. So the output has not really kept pace. And I'm not expecting very great numbers, even though the marketing margins have gone up, from about 3.5, 4 rupees to our estimate is maybe roughly 6 rupees could be the marketing margins that they might be getting. But on the other hand, there will be unpaid subsidies on kerosene and gas, and there have been some reports that the government might do what the erstwhile government used to do, where being that the government runs a cash budget, not an accrual based budget, you just don't pay the subsidies this year. That will have a working capital impact on the oil marketing companies. So those would have been a case for buying in a falling oil scenario, but these three factors, inventory, lower GRMs, and maybe working capital issues on the unpaid subsidies of about 25-30,000 crores, which might not get paid within the year and might get postponed to next year. Those will have an impact on the oil marketing companies.
All right, that's the view coming in from Ajay.